emerging markets look as attractive as gold miners were 2 to 3 years ago. I still have the belief that we're in the process of seeing a peak of the US dollar long term. That's the end of the discussion right there, in my opinion. I don't know how there's a comeback out of that. Junior miners and the small cap names are beginning to attract more and more capital as well.
Okay, guys, so today we have Tavi Costa from Crescat Capital, and I'm very excited because we will discuss the state of the current economy. So we recently had the economy numbers coming out in US. We will discuss commodities, gold, silver, and a lot of other very interesting topics. So Tavi, thank you so much for being here.
Thanks for having me. Looking forward to this conversation.
Thank you very much, Tavi. So I would like to begin by talking about the economy. Of course, we have so much going on. We have the numbers, but I would like to begin by the big question. So what's your macro overview of the current global economy right now?
I don't think it has a lot of changes recently in regards to my views. Clearly, we had a GDP number today that on the surface looks really strong, but when you dive in, it was mostly driven by actual imports collapsing after imports surging in the Q1. So no major shifts. And if you look at the fixed asset investment, things are pretty flattish. And I would say that consumer spending actually was reduced from the Q2 of prior year. So that's what the data came in. Now back to my views. Look, I still have the belief that we're in the process of seeing a peak of the US dollar long term. I think we're going to see a multi-year decline of the dollar versus other fiat currencies. We're still in the development of a commodities bull market, in my opinion, of which has been rotating into different resource types of resources. More recently, metals have been receiving most of the funds. I suspect that energy is going to come back as well into attracting investments as well. And I am extremely optimistic about the rest of the world, particularly emerging markets, because from my understanding, once the dollar turns, which I believe it has, it tends to unleash a lot of capital flows into those economies as a way of hedging, as a way of looking for other more appealing opportunities when it comes to valuation. And lastly, clearly we're seeing a similar, riskier proposition being taken by investors into the mining industry as well. Particularly speaking about junior miners and the small cap names are beginning to attract more and more capital as well. Just as a stat, gold has basically peaked in April 22nd recently. Not peaked, but has really been going sideways since that period, in my view, just consolidating after a large move. And at the meantime, the TSX Venture Precious Metals specifically has been up over 30%. So it is interesting that people are starting to take risk on things that have leverage to gold, despite the fact that gold prices have gone sideways, or should say, not really sideways. From that point, it actually declined close to 10%, but it's gone up since that bottom as well. So yeah, that's basically my opinion on how things in terms of opportunities and how I view things shaping up here.
Sure. And if we stick with US for now, what's your outlook for the next 6 to 12 months if we're talking about the US economy?
I think we're going to see a lot of construction spending. So that fixed asset investment part of the GDP is one thing that I'm very focused on. And this is mostly going to be driven by artificial intelligence build up, and also what we're seeing in regards um, to the onshoring trends, manufacturing things in the US, and all that are very real trends, in my opinion. And the build up for those two aspects are going to be very large. So it's going to drive one of the largest construction booms we've seen probably in the history of the US. The construction spending, just to give you some sense, is about 7% of GDP. We could easily see that double in the next years or so. And no, that's just my opinion on that. I think also if you consider what's been happening with artificial intelligence, it's drastically different than the internet and very different than the real world um, technological shifts, and in the sense of not in the productivity sense and not in the um, you know changes in society sense, but really I think that AI very different than those prior analogs we have in history is creating a real arms race across countries, particularly US and China, to see who gets there first when it comes to full development of this technology. Um, it could be used for evil things, it could be used for good things. And the evil side of it and the good part of it are both driving the need for both economies to really focus to build up as soon as possible. So no matter what happens with the economy, if the private market it starts to decelerate, the public market, in other words, the government is going to step in because it's almost like an existential threat for the U.S. At least how it's been seen by the administration. So we're not going to stop the buildup. So you have to think about three different things when it comes to investing: energy sources, where is the energy going to come from? Where is the second one would be the infrastructure. Where is the infrastructure going to come from? And number three, where are the raw materials going to be from? And those three things are going to, in my view, drive the economy in a large way because we're going to have mega cap companies, most of the technology businesses, the Mag 7, are going to be using their balance sheets and their businesses to leverage the build-up phase of all this, as we were seeing. And all these companies are in the middle of building massive data centers and other types of infrastructure. And you're going to have two economies. You're going to have the spenders and the earners. And so, in my opinion, you want to be focusing on the earners first and foremost. So yeah, that's my sort of way of trying to understand what's likely to happen here with the U.S. economy here.
Thanks for that, Javi. Yes, the dollar is very interesting because I recently had guests who are, they believe we're going to have this crash, so they want to stay in dollar. But on the other side, we have this process of deglobalization where the countries do not trust each other. And like I always say, countries like China, when they look at what the West tried to do with Russia, with freezing their assets, they don't want that to happen to them. So, of course, they want to de-dollarize, maybe go heavy into gold, which has been happening for a very long time anyway. So there's a very interesting dynamics between people still seeing dollar as the safe haven, but also the big players are trying to move away from it.
Yeah, look, early 2000s, we've had a beginning of a multi-year decline in the US dollar versus other fiat currencies. Was that the end of the US dollar dominance? No. Were we seeing deglobalization playing its or deglobalization intensifying at that time? No. Were we seeing central banks buying gold? No. And still the dollar fell. And so my point about the US dollar has absolutely nothing to do with the fact that countries are losing faith on the dollar or either, I think that only adds to the idea. But the bigger idea is the fact that the dollar is too overvalued for where the imbalances of the US economy are. What am I referring to is also three things. Two of them are very related. One is the fiscal deficit. We gotta we got to fix this. If we don't fix this, I think it's going to create an emerging market moment for the US, either in the treasury market or in the dollar market. So, what are your options to fix the issue? One of the things is to reduce rates. And it's very difficult because, you know, you're likely to see inflation staying in place for the next years or so, because I do believe we're kind of unleashed a long-term inflationary era after COVID. And as we see that occurring, we're going to see also pressure from the government to lower rates in order to pay less interest payment on the debt. So anytime you talk to somebody, either they have a, let's just say they have a long-term view that they think the dollar will continue to appreciate versus other fiat currencies. The biggest question I believe you should ask them is, okay, look at the interest payment to GDP that the US is paying. It's about 4 to 5% of GDP that we're just the burden on the debt. Are there any other large economy that is running the same issue? And the answer is no. There are no other economies. If you look at Canada, is less than 1%. If you look at Japan, is less than 1%. If you look at European countries outside of Italy and I think Greece, all of them are substantially lower than the US, Australia, and so forth. And so clearly, the US is going to hit a wall first when it comes to that issue. And so the sense of urgency to lower rates in the US is substantially higher than the same sense of urgency from other economies. And that is likely to have an impact on the FX market. In other words, interest rate differentials between US and other economies is going to shrink, in my opinion, either because the Japanese economy is forced to allow its 30-year yields and 10-year yields to rise, or because the US economy has somehow, either through trade agreements, through treasury buybacks, through imposing a new Fed chair. I don't know how. I mean, there's so many options here, through yield curve control, QE, whatever they come up with here, will likely drive rates lower relative to other parts of the world. And so that's going to be a huge impact on the currency market. And so that to me is the biggest thing. And then the third aspect that I mentioned at the very beginning of this question, that I have three aspects. So one is deficits, number two is the interest payment to GDP, and number three is the trade deficit, of which Trump is trying to focus on. And he's not wrong. When you look at throughout history, the trade deficit right now, they're running close to 3 to 4%. It's something we have not seen since the early 1900s. So, when you think of the economy as a business, there's two types of streams of capital, inflows or outflows. One is your fiscal deficit, so how much you collect in taxes versus how much you spend. We all know we're spending a lot more than we're collecting. And then the other side of your business is how much you're exporting versus how much you're importing. That, at the end of the day, is what is going to impact the debt problem in the US economy, okay? So when you're running deficits on both ends, of which most people here would argue and say, well, but the dollar is the reserve currency. You have to do that. Yes, you do, but you don't have to run an extreme deficit on both sides. That's absurd. And so today we're running one of the largest twin deficits we've seen in history. And I think that alone is completely unsustainable. So you don't fix those two problems with a stronger dollar. Period. You fix those two problems with a weaker dollar. And that's the end of the discussion right there, in my opinion. I don't know how there's a comeback out of that. Now you can see the dollar having monthly changes and maybe even quarterly changes that are against this trend that I'm referring to. I feel very strongly that 3 to 5 years from now, the dollar is going to be substantially weaker, not just against hard assets, but also against other fiat currencies. And if you understand that and you look at the dollar trends, once you unleash a multi-year decline on the dollar, you also unleash capitals coming out of US based assets into other parts of the world. So just as I thought a few years back, gold look attractive, miners look attractive. I'm looking at this. I'm saying emerging markets look as attractive as gold miners were 2 to 3 years ago. So, this is my strong view for what's to come.
That's a very interesting and certainly detailed perspective. Thank you very much for that, Tavi. And so you mentioned the emerging countries, of course, and the market. So what countries would you be interested most right now?
Yeah, you can break it down into a lot of different things because the world is just so, I mean, just think about this, right? A metric that we most should know. If you don't, you should, that about 70+% of the MSCI World Index is weighted on US equities. Why does that matter? It's just a reflection of how much capital has come here relative to other places. So when you have this level of efficiency in one place because too much capital is chasing these assets, on the other side, you have this level of inefficiency on the other side. So people have the same way people have extrapolated these ridiculous projections for growth in the US. They have also projected very low expectations for the near future, 3 to 5 years for most foreign companies. So you can break that down into a lot of very important questions. I mean, anything probably that you do outside of the US is probably going to do better than the US in 3 to 5 years. Of course, I would spread my risk. There's a reason why Warren Buffett has been buying Japanese equities. But even one of the most contrarian thoughts would be um, on the European side as well. But I think that even more than that, where you really make most of your capital. I mean, in the past, every time we see this turn on the dollar, different markets tend to benefit more. So you have, let's just say, in the 80s, or yeah, after the Plaza Accord, we saw Japan really have a run up. And we did see some emerging markets do very well, but Japan was a bubble. We saw at the end of the 80s, the beginning of 90s, that was the bubble, that was the buildup out of the dollar turning in the mid 80s and attracting capital into the Japanese real estate market. So that was your big winner. Then in the early 2000s, your big winner in that case certainly was um, emerging markets in a huge way. Now, Japan also performed well, then, and especially I would say European equities perform way better, but it specifically Japan actually did not perform very well, but European equities perform very well. Latin America and emerging markets in general perform exceptionally well. And so you got to ask yourself the question, what's the next now? I don't think you want to be crazy specific on this and say this is the only country that is going to benefit. It could, in my opinion, the big imbalance is also happening within the emerging markets space. When you look at the index inside of the emerging markets index, where you're going to find is that the weights are heavily tilted on the Asia side. So about 70 to 80% weight on the emerging markets index is Asia. Now, one may say, of course, look at the size of the Chinese economy, but the proportion of this is really off relative to areas like Latin America. So, the same way you may see a rebalancing or rotation out of US based assets into other parts of the world, you can also see a rotation within the emerging markets back into Latin America. So, I am very focused on Latin America right now. Um, I think it's weird to say a safe bet because there's so much corruption and issues in those countries. I'm originally from Brazil, so I saw it firsthand in my whole life. But I believe that that's, if there was ever an asymmetry to invest in Brazil, this is the time now. And Brazil is one place. I mean, there's Chile, there's Argentina is more obvious. There is Peru, certainly Mexico. Um, and but I think that those countries are going to do very, very well. And it can go deeper into this as well, because when you start looking at, for instance, how are you going to fix the trade problem? Like going back to that question the second question you asked, and you run a calculation of which countries are running largest surplus with the US, you're going to find that how you fix those problems is usually through um, a currency revaluation. And yes, we're probably going to see a decline of net imports from China in the US over time because of the changes in onshoring and other things. But Canada and Mexico is highly unlikely you're going to see major changes in that front. So the way to fix those problems are likely to come from a revaluation of the currency. So I'm actually very positive on the Canadian dollar. I'm actually very positive on the Mexican peso as well. And because I think that that's just not priced accordingly relative to those things. So, so yeah, that's a contrarian view, definitely a contrarian view. I'm sure most of your users now have lost me just for saying this, but I do believe that I believe that the Canadian dollar will perform better than the US dollar in the next 3 to 5 years.
Yes, no, definitely does make sense. So Tavi, I would like to move to the commodity sector. If we look at where the world is going, where the big thinkers are telling us we're going to go, with the data centers, with the AI, electrification, all that, we need tons of energy and tons of commodities. And the sector, especially the commodity sector, has been unbelievably underinvested. It takes so long to get the permits, to actually build the mine, so much risk, so much problems. So I assume you're very bullish on a broad variety of commodities, right?
Yes, I think that metals is one side of the raw material side, and you got the energy side of which is another pillar. But raw materials in the metals front is absolutely critical for building. And I like all sorts of industries. The mining industry to me is the most mispriced, but you can find outstanding opportunities in the steel producing industry, iron ore, and recently we saw this investment by the Department of Defense on MP materials. I think that's a very, very interesting twist to the story here, of which the last time we saw a strategic equity investment, not a bailout of this size into a company was in the World War II with factories and all sorts of things. And I'm really interested in this because I think this is not revolutionary, trust me. I mean, you can look at Brazil has plenty state-owned companies. Why do you think Petrobras, largest energy company and largest company in Brazil, is a state-owned company? Because the government wants to have control over how much you're going to charge in the pumps for gas. So, you know, these things they develop first as a strategic idea to help them, and then they tend to progress in the wrong direction at some point. And so it is interesting. And it's also questions a little bit of, okay, if we're seeing the beginning of a trend of state-owned companies in the US, what's the difference between US and Latin America or Africa in regards to that? It's really interesting because we used to say no, and it's all, strongest capitalism we've seen and all that, and it has been the case, but is this the beginning of the end of some of that? So I like to question those things because I think that those are very contrarian views that usually have a lot of room for opportunities. And I think that the engagement of the government in those areas is going to be very large. It wouldn't shock me to see the US funding a gold deposit at some point to acquire gold. Wouldn't that be the easiest way to acquire gold? Just literally helping to build a gold mine and say 50% of the gold that you guys produce is mine. I'm not trying to give ideas out there, but that's literally what happened with NP Materials. 50% of the profits go to the DoD on what they're going to develop together. So it is really interesting. And with a 15% stake, it's really, and they have no saying. Are they going to say no to the DoD? No, they can't say no. They have to say yes. So I find this really interesting what's happening here. And raw materials are on what I believe to be the very early stages of one of the most attractive periods to invest in mining companies that we're probably going to see in a very long time, especially because nobody believes in it, especially because everybody says that these companies are just capital bleeders. And it's almost like they deserve to see the other side of this and then change their views. By the time they change their views, you should probably be selling your position as well. But we're long ways from that. People are very skeptical about the mining industry, and that's yet to change, in my opinion, in a very big way.
Yes, you mentioned Petrobras. They pay really good dividends. I like the company as well. But with the mining sector, Tavi, even at the so we just see the Newmont releasing the results and a few of the other companies, even at the current commodity prices, which are, yeah, they're quite high, but if you look at them 5 years from now, I'm sure they will look cheap. But even at the current prices, the good companies are printing cash. They're doing unbelievably well. They're already acquiring these cheap, undervalued developers or junior producers. So I feel like in time we will slowly start moving towards the juniors as well. That's where the acquisitions will occur, which will be very interesting as well. But yes, I'm amazed at how these companies are doing. Like they're very healthy already, but if the commodity prices continue to rise, I mean, the sector just looks really, really good.
Yeah, and I think that the idea here is that their margins are incredible, and it's not like they're still, in a position where they've been overly deploying capital in the industry and this again destroying capital like they did in the past. We're in the improvement of balance sheets phase, and that's how early we are. That's you're still seeing the improvement of cash balances and so forth. Some companies are still choosing to pay down debt, and some others are starting to see, like I said, we did a leverage buyout of a mine, and it's the fourth largest silver mine in the world now. And what I say to them is that we need to focus like there's no tomorrow on volume, not on improving balance sheet. I mean, that's insane that the majors are now talking about that. To me, volume is the most important thing. Secure supply, that's what you need. And we're not in the crazy, frenzy mining environment at all. Secure metals, secure growth in revenues, that's what you need. And The margins are probably going to stay there for a bit, you know, 3 years or so. And if you're a mining company, you're not hedging your energy cost, if that's a big component of your cost, I think you're absolutely out of your mind as well. So you definitely want to focus on hedging uh, energy in a big way because these ratios of gold or silver relative to oil are just unsustainable. You don't see that throughout history for too long. Oil could really easily have a big run up relative to those metals and change the mining cost structure of these companies in a big way. So take part of your profits, say thank you, and hedge a little bit of your exposure to on the energy side. And that would be my biggest advice to mining companies right now.
Mm. And so, Tavi, would you be during the bull markets, at least historically, usually the capital flows from the metal to the large companies and then goes sort of down the chain. Would you be interested in any specific stage of the mining company, or you just basically look by individually analyze the individual company and try to find opportunities that way?
No, there's a few ways you can invest in this industry. Some people like to be more nimble and have more liquid assets and try to sort of address that trickle down effect more dynamically. I'm going to buy the seniors first and blah blah blah, and then switch it to the smaller names as it trickles down. We've taken a very different approach, understanding that it is very it takes time to build large positions in small companies and very illiquid part of the market and inefficient. Um, we chose the path a few years back to acquire very substantial positions, sometimes 10 to 20% of a stake of a company of what we view to be the highest quality potential discoveries in the world today. And most of them are probably not going to find anything, but it is in this industry, the big money is made in the discovery phase. And so because most of these companies were priced as if they already failed and had no discoveries, we decided to accumulate shares of these things over the last few years. Yes, we've had discoveries happen in our portfolio, despite the fact that the cycle did not turn and they performed very well. But I think that the good side of it is yet to come, of which is when the macro takes care of the stories. And so you start seeing the capital flowing down to those areas and the large mining companies with flush with capital starting to actually redeploy into the smaller names. That's your macro thesis unfolding and starting to drive those stories a lot higher rather than a high quality asset being bid up because it went from having a property to a major discovery, of which is a great way to make money too. But ultimately, it's this frenzy that you have in illiquid assets becoming liquid is to me the most attractive part. It's like bringing liquidity back into this industry in a huge way. We've been in a dried out period in the desert for many years, and I think that I think this is going to be a interesting next couple of years as capital, in my view, starts flowing back into this smaller parts of this industry.
For sure, for sure. And Tavi, are you allowed to mention some of the names that you could be interested in right now in the gold, silver, or in the copper sector, maybe?
I prefer avoiding individual names because people may ask why I've mentioned those and not others, and for compliance reasons. But if you go to our website, you can find the list of names that we like. Um, and I'm sure there's press releases everywhere for things that we've been participating. We invest in over 70 plus companies, and uh, despite being probably, from my understanding, I don't know any other fund that has done better than we did since we launched this strategy in in June or July of 2020. Um, but I think the point here is that um, um, yeah, look, uh, we've had major winners and lots of losers, and still we were able to carry, a very, what I think it's an outstanding performance, and well above our benchmarks and competitors. And so, how did we do it? We don't get hung up in one story. Uh, we diversify our risk by having a bunch of large stakes in different companies. And while people get hung up on saying, "Oh, this story didn't pan out, this story didn't pan out," who cares? Just, it's usually because those individuals have invested alongside with us and lost money on those things, and it's just part of the game. Um, but at the end of the day, the strategy is much larger than one individual or a few individual stories. And it has proven itself. So we think that the best is yet to come, but we're very excited about how we have been able to manage risk and still find a way to perform very well in a market that has not yet seen um, what we think we will see in terms of liquidity.
Yes, 100%. I don't think you can survive the mining sector without having the bucket approach. And for those of you guys who are interested, I will have the link in the description below if you would like to check out some of those companies. So Tavi, I would like to talk about uranium right now. What's your view on the uranium market? I'm personally very bullish on it because of the long-term contracts and the way you can predict the future demand with these utility companies. But what's your view on the current price, and are you still interested for the future?
Yeah, very interested in that. I mean, we just did a contract with Europe now, right, with the trade deal, which is likely to bring, from my calculation, maybe $30 billion or so to this industry from European money. So that's going to be attractive um, for the whole nuclear space. It's a long-term solution to a lot of the problems we have. Certainly not a near-term solution. Now, for those that often think that the problems I mentioned before with energy, because of AI onshoring, are going to be fixed with the nuclear power, are very wrong, very, very wrong, because we're having issues in the next 5 years here. Electricity is surging, and we need energy now, and those things are not going to be here in until 10, 15 years, who knows? But there are going to be long-term solutions to those issues, no doubt. I wouldn't bet against that. Um, the reason why we don't focus on that as much is because um, mostly because I think that the supply side of uranium is not a very compelling story relative to gold or silver or copper or zinc. We have enough uranium in the world. We found enough uranium in the world. And I think that's people downplay that a lot because they're so bullish on it. But, we do have enough of it um, for, if we want to run nuclear plants solely as our main source of power, we would have enough uranium to do that. Now, think about that. So, uh, that doesn't mean the price shouldn't or won't go up. That just means one side of, you have supply and demand. That means you're betting on the demand side in a bigger sense. And the demand side of the argument is very strong and compelling. And the reason why we focus on precious metals and other metals outside of uranium is because you have the demand and the supply side very compelling. So I guess it's one way to mitigate risk when you're investing in these early stage companies that we invest. But again, I don't want to bash the industry at all. I think there's plenty ways to invest there. I think the investment case is very, very compelling. The political case is very compelling. Uh, and uh, and things are changing in that direction indeed. So I just caution people on the supply front because I think that's misleading. If that has ever been said, it's been very I think it's misleading investors. But that doesn't matter. If the demand carries the torch, then I think the thesis is sound. So yeah. So I'm we've owned the bigger companies um in the space, but uh on and off. But yeah, it's not our main focus in this at all.
Thanks for that, Tavi. So we have a few minutes left, and I always like to ask this question. So, there's so many investment opportunities right now. You have the Bitcoins, you have the stocks, the Nvidias. They can hear us talking about the commodities. And for a young individual who's at the start of his or her wealth building path, it could be quite difficult to choose the correct path. So what advice would you have for that individual who's trying to get involved with investing but still has a lot to learn, and maybe he or she does not know where to start?
Well, first of all, I think there's two things. One, ideas that have played out and ideas that have not played out. And two, there is also, um, you know, what to do as an investor. Most important, I think, quality an investor needs outside of curiosity, of which is involved with what I'm going to say, is conviction. And conviction is something you have to build on your own. Um, why is that? I'll explain very quickly why. Because if you buy stock shares of a company and in the next day or two, the shares that you bought are down 30% for whatever reason. With no conviction, you are really going to question your thesis. You're going to question in a way that is going to be very difficult to take advantage of the situation if the situation or the long-term thesis is unchanged. So how do you do that? I mean, a lot of people follow people, a lot of investors follow others online. So for instance, you like a certain investor you listen to, let's say myself, and you bought silver. A lot of people do that. They buy silver because not a lot of people, some people buy silver because I like silver. And they listen to me and they resonate with the story. Like, wow, I think this guy makes sense. I'm going to buy silver. Okay. And then silver goes down 20%. What do you do? And I get messages from those guys asking me, you told me to buy it. Now it's down 20%, and look, buddy, I'm bullish and I'm buying more. I cannot control volatility. That's just part of the game. And if you're not responsible enough to build your own conviction on the story to take advantage of that volatility, you should probably not be touching your money in the space at all. So having that conviction, I always say this, um, you can borrow someone's idea. I borrow Tavi's idea on silver. By the way, there's plenty other guys that talk about silver. I'm not the only one. But let's just say somebody listened to me. They're like, wow, I'm gonna borrow that idea. That's a very good idea that he said, and I'm gonna use that. But you can never borrow my conviction. And that's the change. That's the difference between you and I, right? Not you specifically, but me and somebody else who's investing. And that's going to make the big difference at the end of our careers or so forth, because I'm going to act when prices are down, and I know or I have conviction that that price action is the wrong behavior of that asset class relative to what I think it's going to happen. So I'm going to constantly be taking advantage of these things, while the other person is going to be questioning, selling at the wrong time, buying it at the wrong time as well. How do you build wealth like that? You won't build wealth. You're going to destroy your wealth. And so, um, you know, that's the first thing. If you're a young investor, my suggestion, okay, is learn about emerging markets. What a time to be learning about that. Nothing has happened. It's like there's this, in my view, a big wave coming. That wave did not, it's not like the mining industry where the wave already started. Emerging markets wave has not started yet. Usually comes after the mining industry. Why? Because the mining industry is the easiest one to understand. You go gold moves, and you're like, all right, well, gold is moving. So what else? Well, the producers of gold should also do well. And so you buy those companies. And so you start moving down, accepting more and more risk and feeling okay with that until you get to, all right, well, what are other economies that perform well because they have too much resource that usually have high correlation with those markets? Oh, emerging markets. Okay, well, that hasn't happened yet, right? I mean, some places have, like Argentina, but majority of emerging markets remain as cheap as they can be. And learn about it. If somebody tells you, oh, these countries are socialist, they have terrible leaders and all that, the answer the question, why in the world in the early 2000s they did very well? Did we have a change in the government setting? No, we did not. So what happened? Was it just a capital flow thing? Yeah. Learn about that. Why did capital start flowing there if there was no change in the political landscape? It's because there are other macro factors that matter outside of your political views. And so, I think this is a wonderful time to be learning about that. And those that know well about these subjects, are probably going to be, you got to play a chess game here. You can't be chasing the hot story, right? Like gold is moving now. You want to become a gold expert? I mean, seriously? No, there's plenty gold experts here. You're not going to be, you're not going to be any different than those other guys, most likely. Now, in an emerging market space, you can really you know you can really differentiate yourself from an ability standpoint of discerning good and bad investments because of your time spent on that industry, and so, or that part of the market. So yeah, that's where I'm really excited about. There's other ideas there too that I'm super excited about, like the auto industry in the US outside of Tesla. Why do we not see cars in Europe being sold? And we're trying to fix a trade deficit issue. Can we see that in the near future? A bunch of companies with low PE ratio that could see growth. Imagine selling to the rest of the world, having a whole market, drastically changing your revenues. There's nothing like seeing low multiples of fundamentals meeting growth, right? I mean, that's where you see exponential change in share prices, because low multiples are usually a sign that there's no growth in the future, right? That's what the market's telling you. This thing trades at a single PE ratio because there's not going to be any growth. Well, that's emerging markets today. And what if we see growth? What if we see growth in those companies? So start thinking that way, applying those thoughts into your mind. Doesn't mean any P ratio that is low. There's a lot of what we call value traps out there, of course. So you got to understand, is there a catalyst for growth here? And if there are plenty of reasons in optionality where you can find those ideas, then take a position, see what happens, and start pricing risk and seeing, all right, I'll feel comfortable with this amount and start going that direction. Anyway, so that's my way to, maybe share some of my experience with the younger guys as well.
Yeah, thank you very much, Tavi. It's a very, very good answer. I loved it. So, Tavi, that's all the questions you had, or the questions I had. Is there anything else you would like to mention?
No, I think we cover a lot of it. And no, best of luck for everybody. And no, look, I don't have any crystal balls or anything like that. All I'm doing is just looking back in history and trying to understand where all these imbalances are going to drive, you know, policy shifts. And because I always think from the constraints that drive decisions, incentives and all these things are very important to understand the next moves. And so, um, yeah, act accordingly, I guess, is my 2 cents on that.
Mm. So again, Tavi, thank you very much for being here, and I hope to have you back.
Thank you very much.